The third quarter of this year was a rough one for equity investors, with the TSX down about 8%, but it was also a period that our next guest says showed the true value of active money management. Joining us in the studio is Kathleen Wylie, head of Canadian Equity Research at Russell Investments. Always good to have you in. There's always so much to talk about.
There is.
Let's talk about the September quarter, because active did outperform. 75% of managers did, although they were still down.
Yeah, so the market was down 7.9%, but I mean, 75% of managers beat the benchmark, which is significant, and their median was like minus 6.2%. So they beat it by quite a bit. So yeah, it highlights the value of active management. What you want, and I know a lot of people say, well, the market's down, everybody's unhappy, but in the long run, it does matter. You don't want to fall as much as the market, and it does help long-term performance. So that was key.
When you came in and sat down, I could almost hear you screaming through the press release, but you went back and sliced and diced the data going back 5 years.
Yeah.
And we're talking large cap.
I am talking large
active
cap.
managers.
Yeah.
What did you find?
Yeah, so I mean, it's actually the last 5 quarters have been very good for active management, and there has been quite a bit of negative press about it, which has surprised me. But so we took the data, and there are, and I fully admit this, there are different ways of calculating everything. But what I did was I looked at the number of managers that we had 5-year performance for. I even made this adjustment, which some say is to adjust for survivorship bias. Put that in because I knew that would lower the numbers. And we came out with 64% of managers have beat the benchmark over 5 years. And the excess return of those managers is 330 basis points. So those are good numbers. I mean, if you look at the calendar number, next time I'm here, I'll be talking about the calendar year. But the last almost 5 years have been good for active managers. Not every quarter, and I'm never going to sit here and say it's always going to be great. Managers are always going to beat the benchmark, because they don't. But the numbers don't lie. We look at the numbers, I calculate them, I make sure they're good. What more can I say? Sometimes
they don't outperform because of, and we've talked about this before, the makeup of the benchmarks.
Absolutely.
And September quarter and probably into October, and certainly as of right now, large cap active managers are benefiting if they don't own Valiant.
Yes, for sure. So that was a big problem. I was on here every single quarter talking. Valiant was the top contributing stock for 3 consecutive quarters. And we all know the weight, briefly, it became the largest stock in the index, which is just really difficult. And a third of managers have held it. And so that was very difficult. Everything reversed this quarter. Valiant was down 14%. And so that really helped managers who don't own it. So that was a big key. Also this quarter, gold stocks fell. We talked a lot about gold, and it's not as big an impact as it was at one point because the weight is down, but they fell 17%. So that's pretty significant. Managers are a couple percent underweight. So that helped them. You had good sector breadth this quarter. It was one of these, almost everything kind of lined up. And it was a good quarter for active managers, better than I even would have expected. So,
when you talk about other things, energy, underweight on energy and underweight on telecom, which that struck me as kind of interesting for the large cap, and actually that might hurt them here.
That did hurt. So telecom and financials managers are underweight on average, and those were 2 of the outperforming sectors. But those were really the only 2 that worked against managers if you're looking at the sector. But we need to talk about energy because in all my analysis, and I didn't look at every single manager because it's just too many, but energy underperformed by a lot, and managers on average are underweight. But not every manager is underweight. There's quite a number that have overweights, which makes sense. You know, they see the stocks cheap. It all depends on their style. What I did observe, though, is I looked at the 15 worst, the bottom performing managers, and 12 of those 15 actually had overweights to energy. And so they were definitely hurt. And I think only 2 of them had Valiant. So that's why I say, and I can't prove it mathematically, but the energy positioning had the biggest impact on how managers did this quarter. So
I'm surprised at the underweight in financials.
Yeah, but you know why? The weight is so big, and the underweight is getting a bit larger. It is, last time I checked, financials are 37% of the index, and banks alone, we've talked about banks a lot, are 22%. So yes, managers are underweight those on average, but as we've talked about over and over and over, and you seem to remember every time I say which bank is the largest bank, but the 3 big banks, TD, Royal, and Bank of Nova Scotia, are held by at least 80% of managers in Canada. So whatever happens, you know, at the top, it just matters what those 3 stocks did. And they would have helped this quarter too, because all 3 of those stocks underperformed. They didn't fall one was up, but they didn't fall as much as the benchmark. So
Just two last questions. One is dividend focused as a style.
Yeah.
They've been leading.
Yeah, not they haven't been leading. So this is the
they
first,
haven't been
they
leading.
did this quarter. They
Okay,
were
sorry.
89% beat the benchmark, but they had done pretty poorly for 3 consecutive quarters. So the last time they were the top style was last quarter. And you know, I tried to look at sector positioning in stocks and everything, and I would have guessed just by sector positioning the value managers would have done the best, but in fact they did the worst. The dividend guys would have been helped by Valiant. Only one now holds Valiant. I got to look into that a bit, but now you made me lose my train of thought. Only one holds Valiant, and they have a much larger underweight to gold stock, so that would have helped them as all. But I also did a little bit extra, and of the top 10 contributing stocks, 7 of them were more widely held by growth managers, 3 by dividend managers, and none by value. So it really was kind of a stock specific. And of those 12, you love my numbers, don't you? 12 that had overweights to energy that underperformed of the worst 15, 8 of those were actually value managers. And so it was very specific, different things that mattered. But again, highlights, no one style is always in favor. Growth has had a value now for 6 quarters. How long will that continue? Hard to say.
Well, maybe we'll have you. Maybe it'll switch. I'm actually thinking about the value strategy. We'll have you back in January.
There you go.
After all the numbers are done. Thank you very much, Kathleen Wylie, head of Canadian Equity Research at Russell Investments.